Welcome back to the channel, guys. A lot of you have been asking around doing a specific video around the change of strategy from Incomeshares from the old strategy. So I just wanted to do a bit more of a deep dive into kind of the strategy mechanics, the impact on NAV, the volatility side of things, some things around enhancements that were hinted at in an X post, and just the usual risks and conclusions. Obviously, previously we had the approach of selling 5% out of the money weekly cover calls, which was okay, but it had drawbacks. The current hybrid structure allocates capital between the direct equity and running a cash secure put option overlay to enhance the income generation. So it gives them a bit more distinct in performance and hopefully an enhancement in the income as well. So how does it work? So each ETP invests in 25% in the underlying asset. So that could be coin, Tesla, Nvidia, etc. And holds 75% in cash secured so that they sell the put options. The strikes range from 5% out of the money to 10% in the money for the cash secured puts. So in a rising market, the scenario would be the equity gain, so that 25% stock holding appreciates in value. It's completely uncapped. The puts expire worthless, so you get the premiums. If we were looking at a falling market, your equity loss on that 25% will go down by however much that underlying drops. The puts are assigned, and you will still get some premium, but then you will have to pay out to buy the underlying. Another key thing to look at is the rebalancing aspect. So I reached out to them to ask how would they maintain the 25%, because at some point, if that underlying was to rally a hell of a lot, you're going to get an imbalance. And what ends up happening is on a weekly basis, if the value of the equity deviates more than 5% in any direction, up or down from the target of 25%, the fund managers will sell or buy shares accordingly to return it back to that 25% allocation. Obviously, if they buy shares, it's coming out of the cash. If they sell shares, it's going to go into the cash portion to get that rebalance. Okay, what about the NAV impact? A lot of people are still going back and forth around this. So the core of the strategy is to generate income by selling put options, which is a promise to buy a stock. This can be done with a riskier in the money put for a higher payout, or a safer out the money put for a smaller one. Simple as that. If we were to look at it, let's say we promised to buy a stock at $100 for 105, so it's a 5% in the money put in effect. And for the risky promise, you're paid a $9 fee, let's say. $5 of that is the intrinsic value, which is the liability, which they're not paying out because that goes back to the buyer. The 4% is the extrinsic value, which is the premium, which is what they're actually paying out to us as investors in these ETPs. So if you get higher payout, but higher risk, you could be buying the stock at a loss. The safer bet, selling a 5% out of the money put, you promise to buy $100 stock for $95, and for this safer promise, you're paid a $3 fee. You've got no intrinsic value, no liability, but you've got the $3 extrinsic payout that we would get as buyers of that ETP. You can see a smaller payout, but a lower risk that's occurring there. If we were to directly to look at this from a NAV impact perspective, from an in the money and out of the money puts, again, I kind of want to show this because the strategy could go either way from that percentage perspective. I'm going to pick a like-for-like comparison in terms of the 5%, just so it's even. So if we were to look at it in both the scenarios, the $100 starting point is going to be the same. 75% is the cash and 25 is the equity. And I again keep the maths very simple. $100, translate that to percentage. 75% will be $75 and 25% will be $25. I'm going to look at all the different market scenarios. So we've got the bull market, sideways market, bear market in both of these cases. So if we were to look at the bull market in the money 5%, we can see that we would make an increase in the share price because the equity's gained. It's a bull market. So in this scenario, $2.5. We then get the extrinsic, which is the part that we get paid out, which is $4. The liability 0. The ending NAV is 106.5. But obviously, when they pay out the extrinsic to us as shareholders, it will drop to 102.5. So the NAV has technically gone up from 100 to 102.5 in this particular scenario. In a sideways market is where things get interesting with the in the money put side of things. We still start off with that $100 starting point, but we've actually lost $5, technically speaking, in the intrinsic. So in this particular scenario, the end NAV drops to $99, so $1 less, but then we get the $4 payout and the NAV drops to 95. Now, we've got to be careful when we say the NAV drops to 95, because from a total returns perspective, you're still at $99 because the transfer of capital has occurred from the extrinsic coming out the NAV to you as the individual. So when we look at the total return number, it's the ending NAV number is the total return number, but the end of NAV in post-distribution is just what the NAV will look like after they've paid you out, but it's a transfer of capital at that stage. In the bear market, again, we're going to start off with that $100 situation. Here, the underlying has dropped, okay? So it's dropped by $2.5, so it's gone down. We're still getting the same extrinsic in every single case, the $4. Now, obviously, because we've gone down into our in the money put, the assigned intrinsic is a lot higher, and it's $15. So this is the worst case scenario for us, is where we end up in a situation where we're in a bear market. And we'll see the ending NAV has dropped from $100 to $86.5 now, and then after the payout, it's $82.5. So the worst scenario is still a bear market. But what's interesting is even in the sideways market, we would still lose out a little bit. It won't be that much, but we would still lose out a little bit from total returns. If we were to look at the scenario 2, where we're selling a 5% out of the money put here, again, the starting point is the same. It's $100. Here, we would make the same amount going up in an upward bull market, 2.5, but would make slightly less on the extrinsic now at $3. Okay. There is no intrinsic to worry about in this particular scenario. So the end NAV would be 105.5, and then after payment, it's 102.5. Okay. If we were to look at it in a sideways market, again, we're starting off with the same 100. Obviously the underlying hasn't moved, so no movement there. There's no intrinsic to worry about. The extrinsic is $3. And so we end up with $103. And then after payment, we end up with $100. So in a sideways market, we're actually slightly better off when it comes to the out the money, because we don't have the intrinsic element to worry about. In the bear market is where things are slightly better off, in a sense that we still lose out, but not as badly. So, here we start off with $100. It's gone down by $2.5, the underlying. So NAV's obviously dropped by that much. We've got the $3 of extrinsic, but we're not as impacted by the intrinsic now. And so our end position is 95.5 from a total return. Obviously, after payment, it's 92.5. So we can see how you can make less income. You're wanting more of a bull market. So selling in the money put options generates a much larger payout because of the extrinsic gain, but the higher strike price means that you take on more risk. That could lead to more losses in a downward. Selling out the money put options is safer with a smaller potential loss, but the trade-off is a smaller payout. So as they're targeting income, it's no great surprise that they're looking at the in the money put side of things. So we have to bear in mind that we are going to see some potential decay in these if we are in a negative market still. What's interesting though is because this is 75% of the portfolio only, what we're going to look at is that $25 element that's in this particular example. If we are in a good market condition, they might be selling off chunks of that over time, right? Because it's going above that 25% allocation, and some of that will go back into cash. So it'll be interesting to see how this plays out. This is what I'm showing here is theoretical examples of what could happen in each type of market. But obviously, if we have a really strong bull market and that underlying goes up way more than $2.5 in this particular example, it starts to go into the $10, let's say, they're going to sell a proportion of that to rebalance the fund. And so we need to see what impact that's going to have in the future. They've obviously back tested some of this stuff and they feel like it's going to work quite well. So that part will be quite interesting. What will also be quite interesting is obviously when we have a pullback like we have with coin, where after earnings, it will be interesting to see how when we get that recovery, if it's a quick recovery especially, how much of that 25% is going to uncapped is going to bring a decent recovery with the recovery of the underlying. Again, that's to be seen. It's also been seen to see how much of the 75% just running on options versus 100% of the portfolio, which is what we were doing, is going to eat into premiums. Another sort of hidden element that I've not drawn on here just to avoid too much complexity is obviously interest payments. So they are going to get interest payments on the cash that they hold. And again, that will contribute to the amount of premiums they pay. So there are a few other kind of elements that are not displayed here, but I've tried to keep the core elements here just for the conversation aspects of it. Okay, if we start to look at the volatility engine, I think this is really important for people to understand that a lot of the payments are linked to the volatility. The premiums are linked to the volatility of the underlying, which is why you'll get more payments for one particular stock than another. And I want to break this out. The Coinbase one is a bit of a red herring at the moment because coin dropped quite a lot recently due to earnings. So this yield has jumped quite a bit to 104. It was hovering around the 60-70% prior to that big drop. So we've got the yield, which is what the percentage of the last distribution is against the NAV. We then have the future volatility, which is the implied volatility. We have the historical volatility, which is past volatility. And then we have another metric, which is the 30-day IV rank. And this is looking at, it's a percentage, and it looks at what is the volatility looking like based on the last 30 days compared to historics. And we can see in most of the cases, it's quite low. So what that means is that historically it's been a lot higher. So at the moment we're at 21% low. That means 80% of the time in Coinbase's case, it has been higher. And this has been really seen in the premiums that we've seen that have dropped off. And this is impacting all cover call funds, not just Incomeshares, but it's impacting every fund out there. Some of the strategies are different, and that's why some of the payments are varied so much. And we'll talk a little bit around potential enhancements that could also be made to this current strategy as well. But what you'll also see is in majority of cases, obviously with some exceptions, the yield is tied to the implied volatility. And what do I mean by that? If we look at Tesla, the yield is 51% and volatility is hovering around that same number. Same with Nvidia, 48.5% and 47 and 51. Some of them are gapping, and that will be because of earnings and because of other things happening within the markets. And you will sometimes see a disconnect between the volatility. And you'll notice, even look at the lower volatility ones are the ones that actually see the bigger gaps for the Apples, the Microsofts. Now, if we start to move on a little bit and start to look at potentially enhancements that could be made, and Octave's kind of hinted at some of these with the version 3 and version 4 that he was doing that X post on recently. So he suggested this is version 2 of the strategy change. Obviously, another one is they're moving to being more actively managed. So it wasn't like before they were not trying to be actively managed. They were restricted by what the market makers ultimately would allow them to do and what the market would allow them to do. They were able to, over time, educate and guide and explain why they need to have a more active position when it comes to these things. And so what does more active management typically mean? It means a lot of things. Starting could be closing a position early. So once you've got all of that extrinsic value, the time decay element, once you've got a large proportion of that, it makes sense to close and lock that profit in and eliminate any remaining risk. And they currently aren't doing that today, but it's an ambition that they want to do. Another is rolling a position. So if a trade is challenged, it can be rolled forward by closing the current position and opening a new one with a later expiry date and a possible different strike, collecting new premium in the process. Another element of this is also being able to, as new money comes into the fund, straight away opening new positions. So we're talking about ladders here, but basically it's just, instead of selling a single block of put options at one strike price, a laddering strategy involves selling multiple smaller blocks of puts at different strike prices or expiry dates. This allows them to diversify that risk, spread the risk across multiple price levels instead of just on a single point. It also gives a lot better kind of leveling of the returns. So a proportion of the portfolio is always expiring and being rolled and creating more constant, less lumpy kind of income streams. It also allows them to give them a lot more flexibility. So allows for more granular adjustments to the portfolio based on the market conditions, adding or removing rungs of the ladder as needed. It also allows them, as new money comes into the fund, they're also able to start saying, right, as soon as that cash comes in, even if it's Wednesday, they could open a short position expiring 2 days later or a day later, and they could capture the income from that straight away rather than having to wait till the Friday, opening the new position for Monday. So again, it giving them a lot more flexibility. What are the final kind of risks and conclusions now? Obviously, from a market and strategy risk perspective, you've got the asset price risk still. So the direct loss from the decline in the underlying stock or index, that hasn't changed. It's not going to change. You've obviously got, again, the concentration risk that still remains, the high exposure to that single company's fortunes or that single stock ETP. The opportunity cost, we could get a bit of underperformance in bull markets still because 75% is still options overlay in the form of cash, right? We've only got that 25% in the underlying. But the advantage here now is it's uncapped. You've obviously got the rebalancing, which can impact long-term returns, and then there's obviously the strategy changes that happen along the way. The structural sort of counterparty risks. So we've obviously got the issues risk. So Incomeshares themselves is obviously a specialist purpose vehicle with limited assets, and there is obviously that risk of them themselves as a fund. There's obviously counterparty risk. So the custodian who's holding this, there's a risk there. The final risk is around the kind of liquidity risk, which is the bid offer spreads that could be quite wide, making it hard to sell at a fair price or even buy at a good price, especially during the market stresses. Legal and systematic risk. So you've got the judicial risk. So obviously it's been governed by Irish law, which has its own kind of corporate structure. We've got the issuer's caller risk. So the issuer can redeem the ETP at any time, forcing some kind of liquidation, and it could happen at a time that you don't want to liquidate. And then sometimes there can be conflicts of interest involved with parties and business activities, etc. There's kind of a risk I haven't really called out here, but it is broker risk at the moment and market maker risk, where we're having a bit of a struggle with regulators, with market makers and brokers to get these listed and get them properly out there in the market. So again, I'm hoping this is just a short-term thing, which is why I don't really want to put it as a risk per se, but it is causing a bit of a pain and it's a bit of a hindrance. I've been spending a lot of time with HL, for example, to try and get these funds included there and trying to understand what the challenges are and blockers there are. As a bottom line, who is this kind of for? These are still speculative tools for sophisticated investors with a high risk tolerance. You need to have a deep understanding of options and a tactical view that a volatile asset will trade sideways or experience that kind of modest pullback. These are pure income plays. So, the high yield is not a free lunch. It is a direct compensation for assuming that substantial and multifactored risk can lead to losses. But you're going to typically go into here with a view of this is an income play. It's going to get me that income. It's not a growth play. I understand I'm sacrificing that growth. So hopefully, guys, that was a good overview of the new strategy. Let me know in the comments what you think about the new strategy. Are you buying into the new strategy? Are you waiting to see what happens with the data in our dashboard? I'm still going to be tracking the data. I'm expecting some more data from Incomeshares directly so that we can break out some of the cash elements a little bit better, understand the intrinsic, extrinsic, the interest payments, etc., to give you guys a bit more of a view. I may need to get into a view of maybe trying to track these more regularly, do more YouTube videos directly showing positions live so we can actually understand this a little bit better. Let me know in the comments, actually, if that's something that you're interested in me doing. Okay, guys, as usual, nothing in here constitutes as investment advice. Make sure you always do your homework and just remember all investments involved an element of risk. Thanks a lot, guys. I'll catch you on the next one.